Hi, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory in Birmingham. We thought we'd come to you with a little bit of a market update today, let you know what's going on out there. The S&P 500 has calmed down and regained a little bit of its positive mojo since the beginning of the year. As you'll recall, at one point we were down about 10% in correction territory for the S&P 500. We've regained about half of that. The S&P 500 trading at about 45.75 as I speak, sort of flirting with that 4,600 number. And it's really because the market seems to be getting more of a grasp on interest rates, inflation, and what that really means for the economy. I'd like to just remind folks that, we've talked a little bit previously about how equities, as interest rates rise, equities get less valuable from a multiple perspective. And that's a direct sort of mathematical formula. So, when you all of a sudden start to adjust your expectations for what forward interest rates look like, it causes kind of a sharp contraction. What I have always said is, over the long term, if interest rates are rising because, we're trying to slow down demand, we're trying to slow down an economy that's too hot, that fundamentally means that there's economic growth going on. And that's certainly the case today, right? We see the supply side of the economy unable to keep up with the demands from the buy side. People want more cars than are out there, and so prices are being bid up. People want more services than the current labor force can provide. And that means that the price of labor is going up. And all of these things from an economist standpoint are actually somewhat good because it means that there's a lot of demand out there and we need the supply chain, the supply side of the economy, basically industry, businesses, to catch up with what people want. Over time, that's actually positive for equities. And I would just remind folks that there have been sort of 12 interest rate rising, tightening periods in the modern era. We only really started this whole monetary policy experiment in the 80s. There have been 12 of them, and equity returns have been positive in 11 of those 12 periods. And it's really because of that phenomenon that we just talked about, which is if you're raising interest rates, which the Fed is doing in response to a very strong underlying economy, then your multiples might get punished a little bit because interest rates are rising. But the dominant factor is more likely to be, interest rates are rising because the economy is really strong. And that continues to be the case. We've also come into the conclusion or midway latter innings of earnings season. Earnings season continues to go very, very strongly. About 80+% of companies beating, which is comparable to what we've seen in prior periods. So that has presented a positive story, positive backdrop to the market as well. As always, if you have any questions, please feel free to reach out to either myself or your advisor. I hope you're having a great week, and I look forward to talking to you again soon.
Thank you for tuning in. And if you're enjoying this content, please subscribe to our YouTube channel and click the bell to be notified when we post more.